What's up, guys? Welcome back to DCA. So what we're going to do in this video is take a look at the crypto market and where we're at right now. But we're going to start by looking at the broader economy. And we're going to try and put what's going on in the crypto market into a bigger context. Because I think a lot of people keep making the mistake of looking at signals in the crypto market and therefore saying that because this has indicated a market cycle bottom in the past, that necessitates that must be what's happening right now. And I'll be the first to admit that it's entirely possible that that is the case, that in fact, these bottom signals that we're seeing in the crypto market are in fact true identifiers of a market cycle bottom. However, we have to consider the fact that we have a broader macroeconomic picture which is dictating what the crypto market can or cannot do, at least in the shorter term. And so what I mean by that is that we have to consider what is going on in the broader economy. We need to consider what the stock market's doing. We need to understand the supply chain issues that are going on globally at the moment and are very likely to intensify as we move into the winter. And specifically, what I'm referencing there will be a lot of the issues that may arise in Europe as a result of the conflict between Ukraine and Russia and the resulting shortage of things like natural gas that essentially Europe relies on. Okay, so as we're moving into the winter, there's going to be additional inflationary pressure on the economy. And, I think there are a lot of uncertainties as to how all of these events are going to play out going forward. And as we all know, markets do not like uncertainty. When faced with uncertainty, there's naturally going to be a pull away from risk assets. So that's perfectly exemplified by this chart here. This is the 2-year, 10-year bond yield curve inversion chart. So this is telling us when the 2-year bond yield exceeds that of the 10-year bond yield. That's basically saying that market sentiment is poor and there's a bad or a poor outlook in the long term. So what you'll notice is this has flipped negative several times dating all the way back here to 1988. And you'll notice that in each case, the bond yield flipping negative or a bond yield curve inversion has preceded a recession in the economy. Okay, so we've seen a recession here in 89, here in 2001, here in 07, and then a technical recession here in 2019. And although not an official recession anyway, a technical recession again here in August or July of 2022. Okay, so you'll notice that the bond yield actually flipped negative first back here in April. We only have data here to 88, but in fact, it has predicted a recession in the economy dating all the way back to 1955. All right, so this is just something to keep in mind that the market is negative. The sentiment in the market, regardless of what people are saying that, maybe the bottom is in, the sentiment in the economy is negative at the moment. And that is perfectly exemplified by this chart here. All right, guys. So with that said, let's bring it back to the crypto market. Now, we need to keep in mind, though, as we're looking at this, that in spite of the fact that many of the indicators in the crypto market are sort of signaling to us that we may be near a bottom, we need to recall that the crypto market is not going to act in a vacuum. The systemic risk factors in the economy are going to continue to have a major impact on the crypto market. And, if you are actively involved in the crypto market, and especially if you're involved in the social media aspects of the crypto market, it becomes very easy to sort of lose the forest from the trees because of the fact that, you have so many people out there. The second that one of these indicators sort of hits a historic bottom where this level in the past has told us that, this is a bottom and it's worked in prior cycles. It's worked. So back in 2015, back in 2018 into 2019, these indicators that have historically told us that, this is the end of the sell-off and they've bared out over time, that may very well be true again in this cycle. However, we cannot take that to the bank. When we consider the fact that the economic circumstances surrounding the market now are different. And that's just the bottom line. There's no two ways about it, because if you go all the way back to 2010, since Bitcoin has been traded on exchanges, we have never faced economic circumstances similar to what we're facing now. So with just rampant inflation, in addition to that, we're pursuing a monetary policy of heavy quantitative tightening. All right. So these are all things that are going to impact the crypto market, guys. Looking at these people saying that the market cycle bottom is in, that's fine. And understanding what arguments they're making, that's totally acceptable. But you should also work to understand then the counter argument to that. And I think that is going to put you in the best position to make better decisions going forward. So what we're looking at here is the total crypto market cap. And I specifically wanted to focus in on the altcoin market today. So this is the total crypto market cap, excluding Bitcoin and Ethereum. So you'll notice that I'm excluding Bitcoin, which is unique for the way that I do my analysis typically. And that's just for the fact that, we've seen over these last couple months now that Bitcoin has sort of taken a back seat in terms of its usual position, where it sort of leads the market off. It leads the market in a rally. It typically goes down less than everything else, and it typically goes up more than everything else when we're in a bear market. So the fact that that is what Bitcoin has done in the past kind of hasn't bared out completely like we've seen previously in this cycle. In fact, Bitcoin has gone down less than everything else, but it's also gone up less than everything else. So it's kind of been a lower volatility asset. I do believe that Bitcoin will continue to provide you the least downside risk, simply for the fact that it has the largest market cap. But I think that now that use cases are starting to arise more abundantly for the crypto market, you're going to see that some of these altcoins are going to move into a more preeminent role. So for that fact, we're going to take a look at the altcoin market today. So the thing I wanted to point out is, we have gone on a rather large run over the last a month and a half now. So we are up, the altcoin market is up around 36% on aggregate, and recall, this is excluding Bitcoin, excluding Ethereum. So it's up quite a large amount over this last month and a half or so. And what I want to show you here is just kind of two critical levels, and then we'll look at a third as well. So we have this $350 billion level, and we have this $450 billion level. And you'll notice that as we move up right now, as the stock market has been moving up, as the crypto market has been moving up, pretty much led by Ethereum at the moment, we have now moved into this zone here. And I think that this is going to be a critical zone. So I say that it's going to be critical because I think if you start to see some weakness in the general market right now, so if the NASDAQ goes on even a small sell-off, or the S&P goes on a sell-off, I think that you're going to see a fairly large rejection off of this level. So we're sitting right at a major resistance level. You'll notice that we've essentially hit this level as resistance back as the bull market was really getting started back here in February of 2021. And we kind of hit it as resistance. Then we traveled in this zone all through March, and then we really broke through in April. Okay. But then when we came down, when the market crashed in May, we sort of used this area as support. So in May, then again in June, and then finally in July, before we all know what happened into, the latter half of 2021, when we kind of peaked out in November. All right. So we then came back down to this level as the market went on this huge correction out here in May. So this has been a very important level, this $450 billion level. And this $350 billion level, in fact, was an area of support for the bull market as it was getting started. So we came shooting up in February and then kind of held right into this $350 billion zone back here at the beginning of 2021 as the bull market was really getting kicked off. So the reason I'm pointing this out today is because we are now kind of sitting right at this level. And anytime that you're coming up to these resistance levels and the market has a bearish bias, I get very concerned that, these are the points where you can see a large rejection occur. Okay, so if we just come back here to, back to this prior cycle. So, we're looking at the bear market back here in 2018. And you'll notice that there was this level kind of right here in this $175 billion zone. So we pretty much kind of used that area as support for a small time right before we went up to that peak in January. And then we used it as a support zone right here through January. And then we kind of turned it into resistance as the market crashed in February. And you'll notice the market back then, so we're talking from March 2018 through May of 2018, went on a 125% rally. All right. And you'll notice that where did this huge correction occur? And it occurred right at this interface of this support zone as we were still in the bull market. And then it turned into a resistance zone right here in February. And as it flipped to resistance, we, got rejected, came back down. And as we came back up to it, that's where we got rejected. And it really sent us spiraling down. You can look at a million examples of this, even as you go back to the rally that we saw in June of 2019. You see that as we came up to this huge resistance level right here, right in around the $100 billion level, that's where this bigger rally that we saw back here kind of got rejected. So anytime that the market has a overriding bearish sentiment associated with it, I get worried as we come up to these levels. And I get worried that we're going to see people start to FOMO in because, you're going to have your social media clowns telling you that this is the beginning of, the turnaround. The market has priced in all of the negative things going on, in spite of the fact that we have so much evidence that these type of rallies consistently occur in bear markets. So, you have to keep in mind that you're going to hear people on social media now telling you that as we're coming up into this huge resistance level, they're going to be encouraging you to FOMO in right now. And I'm not telling you that, with any degree of certainty that we can't break above this level, but I'm telling you that you have to be cautious as you're coming to these levels. So if we were to break through this zone, you'll notice that pretty much this area in here, this area from around 450 billion all the way up to around 600 billion, there is going to be some resistance probably at around 550 billion, quite frankly. I don't think it's coincidental that these are occurring at 350, 450, 550, 650, but your largest zone of resistance is not going to be up here until 650. 650 billion, but you very likely will probably see some degree of resistance occur kind of right in this $550 billion zone. So those are areas to keep in mind if, in fact, we are able to break above this. Now, if we are not, then I think you're quickly going to be kind of looking back at this $350 billion zone yet again as we correct down back to a support level. Okay, because quite frankly, we've been forming this bear flag now realistically from April. So we've come all the way down from April, almost in a straight line. We've moved down since April. Then since this recovery started in June, this is a classic bear flag pattern. So, it's something you have to keep in mind as we know the fact that the market has a serious bearish bias at the moment. You at least have to keep in mind such that this is probably not a great time to be FOMOing into the market. We're at this major resistance level, at least a potential major resistance level. And if we see any weakness in the markets, we could very well see a huge correction coming here. All right, guys, so this is just something to keep in mind going forward. We have a lot of indication that we are in a major resistance level at this $450 billion zone. And that is a prime location in a more bearish segment of the market to see the market kind of turn over from here and head back down. So it's not saying that it has to happen, but you at least have to be cognizant of it. And kind of right when you're in these resistance zones, these are not great times to sort of FOMO in. So if you're someone who wants to get more into the market at the moment or, enter a position into the market, it's probably best to take a wait and see approach. So with the broader economy in mind, with the knowledge that there's negative sentiment in the market, there's still a lot of unknown uncertainty coming as we move into the winter. you kind of have to keep in mind the fact that there's a high potential that we could see the market turn and retreat back to some of these lower levels, in spite of everyone telling you every day on social media that the market cycle bottom is in because of X, Y, and Z different indicators suggesting that it is. So that's going to be it for this one, guys. Until next time, as usual, see you.